Hi everyone, I'm John Zaller, CIO of MAI Capital, here with the latest edition of the MAI Market Update. Thus far, the trends that carried us through 2023 have largely stayed in place to start 2024. And one of the most impactful trends has been the continued outperformance of the largest technology companies in the world. For believers in diversification, as we are, the concentration of performance at the top of the market challenges our fortitude to stick with underperforming areas of the market. In this update, we'll look at the top heaviness of the market from a historical perspective, discuss why it is occurring, and why it still makes sense to diversify. The group of tech stocks, now affectionately known as the Magnificent Seven, have seen their share prices soar since the beginning of 2023 and have carried the overall equity market to new all-time highs. Much of this performance has been driven by the emergence of artificial intelligence as a potential game changer for economic and corporate productivity. The chart on your screen shows that the outperformance of these 7 stocks, including Apple, Amazon, Meta, Alphabet, Microsoft, Nvidia, and Tesla, has actually been building since the outset of the pandemic in early 2020. An equal-weighted basket of these stocks has outperformed the broad NASDAQ and S&P 500 indexes by over 200% since January of 2020, which begs the question, where would the market be today without these companies? While valuation multiples have expanded and the Mag 7 stocks now trade above 40 times forward earnings on an equal-weighted basis, it's important to note that these companies have also been outperforming from a fundamental standpoint as well. Looking at almost any metric, these companies have been growing faster and more profitably than the rest of the market. Looking at 2023 alone, the chart on your screen shows that the Mag 7 grew profits at 5 times the rate of the broader S&P 500. Taking these companies out of the index would have resulted in a mere 2% net income growth in 2023. And the outlook for 2024 is for more of the same, with the gap in profit growth closing a bit, but with markets still expecting the Mag 7 to grow profits at over 3 times the rate of the other 493 stocks in the S&P 500. There have been some that have likened the current market conditions to the tech bubble in the late 1990s, when investors became exuberant over the transformative potential of the internet and drove up the shares of early-stage internet companies to unsustainable levels. The primary arguments against that comparison for today's AI-driven enthusiasm is that the companies at the top today are mature, profitable, and not quite as expensive. While we agree that the speculation today is not nearly as extreme, the lessons from that period are still worth considering. With hindsight, the internet proved to be the most transformative innovation in modern history, and yet, the tech-heavy Russell 1000 Growth Index performed terribly for several years following the tech bubble run-up, while other areas of the market that were not caught up in the enthusiasm fared better. The table on your screen shows the starting price-to-earnings ratio of various market indexes at the end of 1999, with their subsequent 5-year annualized returns from 2000 to 2005. We've also added the price-to-earnings ratios as of the end of January 2024, which show a similar pattern to late 1999, albeit a little less extreme. Clearly, starting valuations played a big role in the subsequent returns following the tech bubble, and investors who concentrated in the internet darlings paid the price. Fast forward to today, and AI could very well be the productivity boost that our economy needs for the next decade and beyond, but that's no guarantee that the stocks that are associated with it will produce positive returns from today's valuations. This is why maintaining a broadly diversified portfolio is so important. While being well diversified by definition never produces the absolute best returns, it does promote discipline during periods like today, when it's easy to get caught up in the enthusiasm and give up on areas of the market that seem out of style. This is why we maintain exposure to equities across sectors, market caps, and geographies, seeking to generate the long-term returns available in equity markets without getting too exposed to any one trend. We believe this approach is consistent with our focus on achieving your long-term goals through prudent asset allocation, thoughtful security selection, and a great deal of patience. As always, we're grateful for the opportunity to partner with you, and we encourage you to reach out to your wealth manager with any questions related to your portfolio. Thanks so much for listening, and we'll see you next time.